Compare two identical $10,000 accounts. Risking 20% fails because returns aren't linear. 5 consecutive losses drops this account to 0. But a strict 1% risk rule means only a 5% drawdown. You survive with $9,500. Learning the precise mathematical formula to size your trades ensures that no single string of losses can end your career. Eliminating emotion from position sizing is the first step toward surviving market noise. This strict mathematical approach preserves your capital long enough for a proven trading strategy to actually realize its statistical edge. Step 1 requires you to define a fixed dollar risk before you open a single chart. It is a mistake to equate available margin with actual risk. Margin is simply the borrowing power provided by your broker. Absolute risk is the specific amount of your own capital you are willing to lose on one trade. For a $10,000 account, the math is simple. Multiplying your balance by 0.01 gives you an absolute risk limit of exactly $100. Risking only $100 can feel like trading for pocket change, especially when you are spending hours analyzing footprints and order flow. However, a $10,000 account functions as a laboratory for data. The priority is to demonstrate that you can produce a sequence of trades with consistent returns and minimal drawdown. Take this planned euro trade as an example. You must identify an entry price and a stop-loss price based on the current market structure. The stop-loss is your point of invalidation. Its placement must be determined by the chart, such as a break in a value area, rather than an arbitrary number based on your desired profit. Use your platform's measurement tool to find the distance between these 2 points. You are measuring the physical space the market must move to prove your trade idea wrong. In this setup, the measurement tool shows a distance of exactly 20 pips. This becomes the critical variable for our final calculation. Identifying this hard distance on the chart removes the guesswork. You are no longer guessing how much to buy. You are letting the market structure define the trade. Step 3 uses a specific formula to bridge your $100 risk limit with that 20 pip distance on the chart. First, divide your absolute risk of $100 by your stop-loss distance of 20 pips. Then divide that result by the pip value for the asset, which for the euro is $10. This reveals the exact unit size needed for this trade, 0.5 lots. Even if you are highly confident in a setup, skipping this calculation is dangerous. The random distribution of wins and losses means that any single trade could be the start of a losing streak. Calculating your size for every setup is the only way to ensure you remain liquid through these inevitable statistical fluctuations. The final step is moving the math into the order execution window. In the volume or lot size field, enter 0.5. This matches the formula's output precisely, with no rounding. Before clicking the execution button, you must perform a final verification by looking at the order summary. Confirm that the platform displays a maximum potential loss of exactly $100. Verifying this limit completes the transition from a speculative idea to a controlled business transaction. With the trade active, your risk is capped. Even a loss leaves 99% of your capital available for the next opportunity. When this process is repeated over hundreds of trades, it creates a verified track record. This data is the primary requirement for professional firms seeking traders to manage $500,000 accounts. At that level of capital, a 5% monthly return results in $25,000. The risk remains at 1%, but the professional scale changes the financial outcome. If you require adrenaline, look for it outside the markets. Trading for a living is about the steady application of statistics. Success is found in the repetitive, disciplined execution of these steps. To calculate the position size for your next trade, use the link in the description.